Good morning and welcome to the Prescient Investment Management interest-bearing webinar for Q1 2023. My name is Natalie and joining me today I have Bastian, Reza and Henk. The challenging global macroeconomic conditions of 2022 followed us into the new year, with markets experiencing no reprieve in the first quarter of 2023. Today we will reflect on some key events that have shaped the past quarter and discuss our expectation on the fixed income markets going forward. So firstly, we have heard a lot of news in the last few weeks about heightened risk amongst global banks. We saw this starting with the run on Silicon Valley Bank in the US, and then this seemed to spread across the Atlantic to Credit Suisse in Switzerland. So Basti, is this something that should be of concern to investors? And would you say this is similar to the 2008 GFC, which was also characterized by bank defaults?
Thanks, Natalie. Yeah, and thanks everybody for joining. Indeed, obviously something which should concern us. Too meaningful these events to ignore them. I do think though that we don't have a similar situation as 2008. We had a bank default, a bank run, a bank takeover, the Fed jumping in, bailing out. But despite that, the situation is quite different. And I think the different approach of the Federal Reserve, the fast approach, this time has actually led to us assuming that everything is well under control, and market metrics do actually suggest so.
Okay, so what exactly are those indicators that the Fed has handled it well and has everything under control?
There's quite a few which we could look at, or which we do look at Prescient. Give you an example. I mean, equity prices is the first simple indicator. Equity prices have recovered quite nicely. That can be on different news, but you can also see that implied equity volatility is down again, so there's not that much panic in the market. More directly, more targeted, we would look at credit default swaps, where we can have a look and see whether the market is demanding an excessive, or compared to the past, much higher premium for insuring banks against default. But I would suggest to just let's look at the data together. Okay, cool. So one of these themes which we am featuring this year, obviously driven by what happened to Silicon Valley Bank, is a potential global banking crisis. And as I said, we do observe quite a wide range of metrics to see where we are with this crisis. First chart, we're just basically showing the US aggregate bond index and the spread thereof above risk-free US treasuries. And you can see that we haven't really seen a dramatic spike and that we're already on our way back down. I also mentioned implied volatility. Implied volatility is a good tool. The VIX is often called the fear gauge to basically measure how much risk is priced into the market. And you can see that this, for example, is a COVID spike. We haven't really seen a massive spike here. And again, we are on our way down. Most targeted, I'll go back to credit spreads. We can look at the spreads of the individual banks, which we're going to do in this chart. And these are 5-year credit default swap spreads. So basically what it costs in basis points on the y-axis to insure against bank default. Before I go into the individual banks, which are represented by these different lines, I want to highlight that this is a great financial crisis where you see that a lot of spreads are really spiking. We see the aftermath of the European sovereign debt crisis here, with a lot of banks being priced to be much closer to default. We see idiosyncratic risks in this line here. For example, that was Credit Suisse basically on its crisis 2016-2017. And then at the right-hand side of the chart, just highlighting Credit Suisse, you can see that we see this massive spike, but also that it is pretty isolated. So it's the credit default swap of Credit Suisse spiking, but not so much the credit default swap of the other banks. So not a systemic crisis, quite isolated to Credit Suisse. And as we know, Credit Suisse has been taken over by UBS by now.
Thanks, Basti. So maybe you can just walk us through exactly what the Fed did to contain the situation.
Yeah, I guess most importantly, they moved very quickly this time. There was less talk about moral hazard and less talk about whether the taxpayer has to once again pay for all of this. It was a very targeted, quick move to bring down basically panic, and with bringing down panic, the run on banks would actually abate quite quickly. So what the Fed has done very quickly is to create the Bank Term Funding Program, and within this program It is possible for mostly regional banks, but actually for all the banks, to borrow at the Federal Reserve basically without any risk, and with that they have quite a lot of liquidity which they can use to basically pay for the fact that deposits sometimes get withdrawn. So the whole issue about a liquidity crisis is temporarily removed. So what we can see on this chart is a portion of the Fed's balance sheet, and this is a section which basically covers what they call loans, and that's where we also see the wrap-up of the bank term funding program. So you can see 2008 they've issued similar loans already, a different program, different approach, but it helped very quickly to calm markets during the great financial crisis, and it avoided more damage during the great financial crisis. We also saw lending programs or funding programs during COVID, which have then basically been run down later on, and then at the beginning of the Silicon Valley saga, we see a massive spike in loans on the Federal Reserve's balance sheet, and that's exactly the usage of the bank term lending program. And I mentioned earlier that the crisis seems under control. You can see if you look very carefully into this chart that at the end of the spike for 2 weeks now, we see that some of the loans are starting to be repaid already. So the bank term lending program has been used extensively by mostly regional banks to contain the crisis and to have enough liquidity to basically pay for deposits which are taken out of the banks, but the usage of this program has started to recede slowly over the last couple of weeks.
So looking at your chart, it does seem like the Fed is easing again. Would you say this is possibly the end of quantitative tightening in the US?
That's a good question. We get this question actually from quite a few clients. So the Fed's balance sheet is now growing again. In fact, it was quite a significant move higher through the bank term lending program. More than $300 billion have been added to the system, or added to the Fed's balance sheet, and that's a reversion of more than half of what we have achieved during quantitative tightening over the last couple of months. So has QT ended already? We don't think so. Yes, the balance sheet has grown already again, but that is, as we think, more temporary. You must consider that the bank term lending program has a limitation in terms of its term of only 12 months. So we should expect that this loan facility starts to recede, and as I've shown, it started to recede already. And with that, the balance sheet automatically will shrink again. Another reason, though, and that's probably the more important one, why we think this is not the end of QT is if we look at the composition of the balance sheet of the Federal Reserve. So through a typical QE program, what the Federal Reserve does, it buys US Treasuries, it buys mortgage-backed securities, and in return, by doing that, it pushes cash into the system. The opposite is obviously true through QT. So basically taking money out of the system by having these mortgage-backed securities or the treasuries expire, and that hasn't stopped. So the Fed is still doing that. But once again, I would like to show you in 2 or 3 charts. Okay, I'm starting off once again with the loans program, basically the bank term funding program, which I've discussed just now in the previous chart. And now I'm going to add on mortgage-backed securities to the balance sheet, and I'm also going to add back on nominal notes and bonds, i.e. US Treasuries. And I'm going to now actually take out the loans and focus on these 2 lines, and you can see that the runoff on the right-hand side of our mortgage-backed securities and of our nominal notes and bonds, the reduction in the balance sheet has continued. In fact, over the last 2 weeks, we've seen quite a significant reduction, not more significant than before, but same pace in terms of reducing these assets. So the Fed has created, with the loans program, I'm going to add it back on now quickly, with the loans program, the bank term funding program, we have created a temporary facility to basically get hold of the potential new financial crisis. We got it under control now, but the runoff of mortgage-backed securities and nominal notes and bonds has continued. So we see more tightening coming through the system as we speak.
And Basti, tying this back to the persistent theme that we've been experiencing around central banks over the last few years, what does this say about future rates? And do you think that the Fed has reached the end of their hiking cycle?
Yeah, that's a good question, especially since we are holding a fixed income webinar here. So what does it mean for the Fed pricing, and where are we going to from here? And that will link straight into Reza speaking about bonds and Henk about income. So yes, the answer is yes, we really think that we are kind of at the peak of the hiking cycle. I'm saying kind of, don't want to sound, don't want to come across with little conviction, but there might be one more last 25 basis point hike. That's what we priced for. But after that, we really think that the Fed is done, and from there eventually it will be cuts. But let's look at what the market is pricing and what that means for asset class pricing, because that's where, again, already new risks, unfortunately, start to emerge. Okay, so let's see what central banks, in this instance the Federal Reserve, really has been priced for, where the market sees the Fed to move over the next couple of months and, yeah, almost years. And then also let's see how that links into asset class pricing and what our take at Prescient is on this pricing. So I'm going to start off by looking at the Fed fund rate, the effective Fed fund rate right now as we speak, sitting at 4.83. That's in the targeted window of 4.75 to 5, exactly what the Fed is targeting. And now I'm bringing in basically what the Fed is priced to, so what the market thinks where the Fed will move over the next month and in the years, as I said. So on the x-axis you can see the timeline going all the way back until 2020, all the way forward until 2025, and on the y-axis you see the interest rates. And you can see that the market tells us there will be maybe 25 bips more of hike. Actually, in fact, as of today, we are priced to an 80% probability of one more hike, but that after this we will really have seen the peak, and that the market is also telling us that we will see quite a lot of cuts all the way down to 3%. So that's basically 8 cuts until the end of 2024, which is just 1.5 years away. So that's a quite strong assumption of the market in terms of what we will see in terms of interest rates cuts, and that is to some degree a good thing. It means that the market tells us that the Fed put is well in place. It tells us that the odds of a recession are quite high, but that with this recession there will be interest rate cuts and the Fed will once again bail us out. Having said that, there's also a risk in that assumption, and I want to just show that quickly by bringing in the dots. So what are the predictions of the Federal Reserve of where interest rates are going to be? And if I focus on that, you can see that the Fed is telling us, yes, over the long term, we're going to be pretty much exactly where the market is pricing us to be, but the Fed has so far not flinched. Okay? So the Fed is still telling us that by the end of this year, we're still going to be at 5%, actually slightly above 5%, while the market has already started to discount interest rate cuts, actually with a quite high degree of probability, i.e. pricing in 1% lower interest rates by December this year. So that is a risk to markets. We think the Fed is done. We think from here interest rates are going to come down, and all of this is good news. It's good news for our position. We remain very positive on SA government bonds, very positive on the front end of the curve. Henk is going to speak to that. Yet there's also a little bit of a risk in our assumption, because we do see that the market has discounted quite a bit of the Fed cutting rates already.
Thanks, Basti. So the Fed is pricing for future cuts, but let's look a bit further out on the curve now. So Reza, what has the recent degree of turmoil in the US banking sector meant for longer dated bond yields? And perhaps you could comment on some of the key factors at play here, such as subdued credit extension from smaller banks, monetary policy normalization agenda, growth, and how this has affected your view on bond yields.
Thanks, Natalie. That's a mouthful, but I'll try and do my best. And thanks also to all our viewers out there. So yeah, I think following on from what Bastian has said and laid an excellent foundation for us to contextualize everything, I think it's very important that we sort of characterize the turmoil that has happened in the US with regards to the banking sector there. So what we do know is that if we look at the period since the financial crisis, we find that looking at the role of central banks, there are two sort of broad mandates, right? The first one is an explicit mandate from Congress to manage prices, so price stability, maximum employment, and to foster low long-term interest rates or borrowing costs. That's the explicit mandate. But they also have an implicit mandate to foster general financial stability, right? So what has happened since the financial crisis has been that those two imperatives have largely dovetailed quite nicely. So the problem coming out of the financial crisis was that you had anemic growth and low inflation, which required low policy rates. Also coming out of the financial crisis, you had a crippled banking sector, which required lots of liquidity, right? So in the period just prior to COVID, you needed low rates and ample liquidity, and those two fit into each other quite nicely. So for the first time now, you actually, in contradistinction, for the first time now, you actually have those two imperatives requiring sort of different sets of toolkits, right? So as you know now, we're struggling with high inflation, so we need tight and high policy rates. But now Silicon Valley Bank comes along, and right, and once again the banking sector, is in requirement of liquidity, right? So what to do? How to balance these two competing sort of objectives? But as Bastian has alluded to, this is actually it's actually an easy puzzle to solve for the central bank, because we have a situation where we're not dealing with a very widespread, a very pervasive problem that is affecting all commercial, multinational, systemic banks. We're actually not finding that. We're finding that we have idiosyncratic problems by small regional banks due to idiosyncratic reasons, poor asset liability management, for example. And this has allowed the Fed to actually navigate these two sets of competing objectives, in the sense that they were able to offer liquidity to these smaller regional banks, but still maintain their monetary policy agenda for restoring price stability via hikes. And we've actually just come out of a period in March now where we've seen a hike. Perhaps it's a little bit easier if I show you by virtue of a couple of diagrams. So let's just look at that quickly. So the first thing I'd like to draw some attention to is just this plot of volatility. It looks quite an intimidating diagram, but let's just take off some of the features over here. So what this is it's called the spider plot, and it really just gives a degree of volatility that various indices have been experiencing over different periods. So what we can see a year ago, you see the indices which actually dominate volatility is emerging market, the VIX index, which Bastian has described as almost like a fear gauge. This is the market's risk-neutral expectation of future volatility. That's what the VIX is, and we have it in its normal form and the form that relates to emerging markets. We've got gold there, we've got emerging market FX, and so on and so forth. What I really want to actually draw to attention for everyone is just the MOVE index. So what this is, it's basically a measure of expected volatility in the bond market. So what we can see that is quite atypical is that the amount of volatility that is expected from the bond market far outstrips the equity market and the forex markets, which is historically an atypical phenomenon, right? So if we just look at the MOVE index here, which has been standardized here, we can see that its current value is 3 standard deviations away from, let's call it a normal mean level. And what that means is that the MOVE index is now greater than about 99.9% of its history. So that just gives you an idea of the degree of expected volatility that has been priced into the bond market, right? So that's just one thing that I wanted to show. The second thing that I'd like to show is essentially what, and this is perhaps a little bit more directed to your question, Natalie. So this is a decomposition of the US 10-year bond yield, one of the most important rates in all of finance. And what it shows that if we look at the date here, that's on the 6th of April, this is showing you that the overall rate here is about 3.3%, and that can be decomposed in a number of ways, which we'll go into in just a moment. But what is quite interesting is just to look at what has happened in terms of the change in this yield and its underlying components since the 1st of March. So for that, we scroll a little bit downwards and we can see what has happened. This is a bar chart or waterfall diagram of the changes in the US 10-year bond yield essentially over the March period. So what we can see is that if we just look at top level, there's been a 70 basis point decline in the US 10-year bond yield. And how does that come about? Well, it comes about in 2 different components. The first one is that the expected short rate component, the average expected short rate component has declined by about 30 basis points. And then we have something called the term premium. And the term premium is essentially the excess compensation that investors would want for holding a 10-year bond as opposed to rolling over a series of 1-year bonds 10 times. So what you notice that component has also declined. Now, why would we see these phenomena? Firstly, why would someone have a situation where the term premium starts off being at negative 41 basis points and becomes even more negative at negative 70 basis points. That's basically saying that investors now, via this negative term premium, are actually willing to pay up and willing to forego any kind of positive compensation for holding a 10-year bond, as opposed to rolling over a series of 1-year bonds. And why would they do that? They would do that and forego this extra premium because of the assumption that they think that there's a lot of risk that's going to be on the cards, and they're assuming, one cannot be obviously sure, but they're assuming that this will become a crowded space and that there will be a clamoring for a perceived safe haven bond like a US 10-year bond. So that's the one thing, is that investors are via this instrument saying that there's lots of risk abound. And the second thing, if we look at the gold component, average expected short-term rates coming down 40 basis points. This really reinforces the view that Bastian has just described to us, in which the bond market has opted to take a very pessimistic view of what's going to happen in future. They are saying that average short rates are going to decline. In other words, it's saying that you are pricing in cuts. This is just another way of looking that risk is going to increase, and the propensity of the market to offer cuts, that is also now increased, right? So lower cuts in future is what, lower rates in future is what the bond market is essentially telling us.
Okay, so you've mentioned some terms that are quite complex, like declining US term premium. How do these factors actually translate into something that's useful and usable as a bond portfolio manager? How do you incorporate these into your bond models, and what other factors do you consider here?
Thanks, Natalie. That's a great question. So if you were to sort of think about yourself now as an investor in a potential, let's call it South African 10-year bond, let's just say, what are the determinants that could speak to how good or how badly you do with this bond investment over the next year, right? So potentially you might say one of the determinants are what was your initial acquisition price, like how much you paid for the bond. So generally speaking, if you find that you don't overpay for a bond relative to, let's just say, its intrinsic or some kind of equilibrium value, then let's just say statistically you tend to do well, right? There might be other things that also can weigh in and influence on how well you're going to do from the bond, the level of global growth or the strength of the dollar. There may be a range of things, but in order to actually show you this quite concretely, let me show you this via our actual bond screen. So what we have in front of us is a tapestry, a dashboard of sorts that essentially shows a range of factors. These factors might be grouped by very intuitive headings like valuations, as I was alluding to, which simply relates to the acquisition price of the asset in question. In this case, we're talking about a bond. So valuations related factors, economics related factors, financial conditions related factors, and sentiment related factors. So what we've simply done here is we've said which are the key determinants that have the best predictive ability to sort of show what you're going to be doing, what you make out of a bond investment over the next 12 months, right? So these factors have been statistically tested and have been included in the model with differing weights, based on their predictive efficacy. So within valuations, for example, we can see that gets the lion's share of the weight. That is sort of 65% of the determinant as to how well you're going to do from a bond relates to the initial price. And the sub-factors here, so you can see real yields, relative yields, South African term premium. This was one of the technical terms you mentioned a little bit earlier on, the US term premium, and so on and so forth, right? So let's just delve a little bit into one of them. So going into South African real yield, what we can see is that interest rates have an inherently mean reverting nature about them. And so what we do know is that you tend to do well when you buy a bond at a yield that is somewhat above some measure of its equilibrium value. So if we look at real yields, for example, you can see that generally speaking, since the introduction of inflation targeting in South Africa in February of 2000, you can see that at a 10-year real yield has hovered more or less in a mean reverting like nature about its long-term median, which sits just below 4% real, right? So what we can see is there certainly are ebbs and flows, but generally speaking, we've discovered statistically that when you enter into a bond at a point at which it exceeds its long-term mean or equilibrium value, you tend to do well from that investment in the following 12 months. And this is one of the tools that we're using in our toolkit to get to a position or to get to a suggested duration stance, right? Let's just look at some others. I'm not going to go into every single tile, but let's just look at something like the strength of the dollar, which is also used in the mix, and at the moment is contributing negatively to the bond score. And why would that be? Well, we know that a strong dollar generally affects asset prices in the same form that high commodity prices would affect an asset price, right? So a high commodity price generally weakens your terms of trade, and it basically is like a tax on real disposable income, and by extension it's a tax on aggregate demand. So what we can see here is that coming out of the beginning of the hiking cycle, you generally had almost a problem for emerging market economies of a strong dollar, leading up to perhaps a little bit the early part of this year. But in general, you can see that the general strength of the dollar relative to its key trading partners has been well in excess of its long-term equilibrium value, right? So these values, these factors get thrown all into a mix, they get amalgamated, and they give an overall score, which you can see here summarized by the 0.17, and that in turn translates us to a dial of sorts. And as you can see there, the dial is now stationed in a moderately positive position, meaning that taking all these factors into account with the stars aligning in all the ways that we've basically shown it, you want to have some active duration, perhaps not as much as if the dial was in strongly positive, but yes, you do want to have some active duration, and this score is systematically informed by our sort of multi-factor tapestry as we show there, and as I said before, the weights have been solved for in terms of their predictive efficacy.
Okay, so the model is integrating these macroeconomic factors. It's then arriving at a score, which then suggests a duration stance. So from there, how do you determine which bonds are optimal, and how does this translate into risk-cognizant portfolio construction?
Okay, another great question. Thanks, Natalie. So one of the advantages of having a sort of a systematic process is that you'll recall just a moment ago I showed the aggregate score that we have, which in turn informs our duration stance. But one of the advantages of having a quantitative systematic process is that we can actually trace the score through time over very, very long periods, right? So what we can then do is we can combine our knowledge about what the score would have been at a particular point in time to subsequent developments on the yield curve, and we think that the marrying of these two elements, you know, is quite powerful. Perhaps an illustrative example is perhaps good and opportune at this time. You know, just simplistically, what we do is we try and say, let us look at 12 months subsequent developments on the yield curve every time the model was in a particular state, right? So if I were to just simplistically say, let's pretend that we've got a deck of cards. I've got the deck of cards behind my back, and I ask you what's the chances that I maybe pull up an ace of spades. If it's a normal deck of cards, that probability is 1 in 52, right? 52 cards in a pack. But now let's say I change the game a little bit and I say, okay, what's the chances of pulling the ace of spades? You know, conditional on the fact that I've got an ace behind my back, right? So now your chances are 1 in 4. So depending on what you condition on, depending on what your probability is conditioned on, you can get radically different answers. And that's sort of almost a little bit of the ingenuity of the model, in the sense that the cleverness is related to what exactly we condition on. So by way of an example, I'd like to show you that in the portal itself. So this is approximately what I was alluding to. So what we can see, if we can just put off some of the things, you'd recall that we are in a moderately positive state. So I'll take off all the other states. So what we simply have in front of us is a distribution of yield curve outcomes, or changes, or average changes in the yield curve over the 12 months periods following every time that the model was previously in a moderately positive state, as it is now, right? So it's in a moderately positive state now, and we have a distribution of what is likely to happen. So the first thing to note is that, let's call it the mode of this distribution, or the kind of values that occur most frequently, generally points to some degree of compression that is to be had, right? So that's obviously a good sign, given that we want to be adding some active duration at the time that the dial is in moderately positive. What we can see is that despite the shape and the mode of this distribution, is that the distribution does have tails. So it's got a left tail here, indicating that there is a little bit of a fatter probability, or a little bit of a higher chance that you have an outsized amount of yield compression. That can happen, but that's not very statistically likely based on this distribution. Similarly, you can have an outcome in which yields actually sell off at the same time that the model is actually asking you to add active duration. This is not obviously ideal, and it can happen, but although that the statistical probability of this is again very, very small. Thankfully, we know that, and as mentioned earlier, the mode of this points to some degree of compression happening, right? So this is neatly summarized by the box and whisker plot. I won't go through all of them, but just focusing on moderately positive, we can see that certainly the median here, since we are working with the box and whisker, the vertical line indicating a median there, and if we read it the value, that's showing you the median value there, 30 basis points of compression. So that is something that we certainly are happy to see. What we then do is, since we are armed now with the knowledge of what is likely to happen to the yield curve on average, we take this one step further and we look at the entire term structure of bonds. I'll just pop this onto moderately positive because that's where we are now. And now I can get an expected return taking into account all the attributes of each and every bond that we've got on the term structure, from the R186 to the newly minted R2053, which is a very new bond. But each of these bonds have got various attributes which we know mathematically beforehand. We know what its coupon is, we know what its all-in price is, we know what's its duration, we know what the convexity is. So, and now we can go one step further. We can also say that I also know now what is going to happen on average to the particular part of the yield curve that each of these bonds happen to find themselves on, and I can compute an expected return. What we can see is that in the moderately positive state, it's not the case that the long end bonds are star performers. As you can see here, the R209 outperforms some of our more long dated bonds. If we just switch on strongly positive just for the moment, we can see here that the back end in the form of the R2053 and the R2048 starts to outperform all the other bonds, but that's to be expected since the degree of yield compression that one expects in the strongly positive state is more than what one would expect in moderately positive, and the duration and convexity attributes of the long-dated bond starts to kick in and those bonds outperform. So this is a neat statistical way to confirm what our intuitive guesses would have been for where we should be on the yield curve given our level of expectation about yield compression, right? If I were to just for the moment, just for purpose of illustration, just show what would happen in the neutral case and switch off the others, what we can see there now is that there's a clear rotation away from the back end on towards more the front end of the curve, in which the roll attributes or characteristics of the bond become more pronounced in an environment in which the model is essentially saying yields are fairly valued, and so it cannot be your base expectation that yield curves compress or sell off in any meaningful way, right? So we have this armed with the knowledge of what different bonds would do across the term structure. We can now go one step further and even incorporate some risk management as well. So what you see in front of you is essentially a plot of two portfolios, portfolios A, stylistically just called portfolio A and portfolio B. What we can see is that in terms of the mean amount of alpha that portfolio A and portfolio B registers on over a 12-month rolling period relative to the ORBI, the mean for the blue portfolio is greater than the mean for, let's call it this rust color. However, what we've also plotted on the same set of axes is the 99% VAR level for both the blue portfolio and for the rust color portfolio. And what we can see is that clearly, although there's very little distributional weight onto the left tail of this distribution, we can see that the 99% VAR of the blue portfolio is about -6% relative to the ORBI, which is quite considerably higher than the 99% VAR level for the rust color portfolio. So what this means is that there's a 1 in 100 chance that the blue portfolio is going to expect a loss relative to the ORBI of at least 6%, whereas there's only a 1 in 100 chance that the rust color portfolio will experience an underperformance relative to the ORBI of around only 4%, right? So what we then do is we incorporate a similar kind of thinking, a similar kind of paradigm to the expected return framework, which I showed just a moment earlier on, and we subject all of the bonds on our term structure to precisely this kind of thing, where we subject them to their value at risk attributes, and we see what the optimal way to combine a portfolio is based on exactly these attributes.
So that's quite a lot of steps, quite comprehensive. How does this all come together in the actual portfolio?
Thanks very much, Natalie. I could give you a long-winded answer, but I think the best is for me to actually show you in living color how this actually comes together. So as we alluded to, in terms of our systematic quantitative process, we've got a portfolio optimizer. And this is exactly what you are now looking at. So what it takes as inputs, it takes the state of the model, as we've said, moderately positive. You can select the particular mandate that you're looking at. You can select what you are wanting to plot on the x-axis, and in this case, our risk metric of interest is value at risk. And then you can really let the machine do its work. What it will really then start to tell you, it will start to tell you certain portfolios that breach on the value at risk metric, and we want to exclude those. We want to see those. We want to exclude individual bonds. We want to say which of these metrics are actually going to be included in the optimal portfolio calculation. So what we can see here is that we've essentially got about 10 entries in which we've got certain combinations that have got a very, very similar expected return. As you can see, the expected return here, 15.45%, and the one 10 places down is only 15.41%. So not a lot of daylight between the two, and all of them within the value at risk threshold, which we also specify upfront in order for them to be eligible for inclusion. So what we then simply do, we simply say, okay, we have a 10 basis point catchment window, and we have the value at risk characteristics of each of our portfolio combinations that we can see here sort of on the y-axis, and we then weight them based on their value at risk attributes in an inverse manner. So those with the lower value at risk figures will get a higher weight, and those with the higher value at risk figures will get a lower weight in piecemeal fashion, right? So what we can then see is it shows you all of these gold bubbles, which shows you all our eligible portfolios that have been included in the computation. And finally, just to summarize all of this, we get what's known as our optimal portfolio that's shown under target here. And you have, what is this, a series of about 7 bonds that needs to be included. What we can also see at the touch of a button is the current portfolio configuration, and we can see how it stacks up relative to its target configuration, and it will tell you exactly what percentage of the portfolio to trade out. What you might notice there just optically is that there's quite a bit of 2048s to trade out in order to get to target, and that's because the model just very recently transitioned from strongly positive, where it had a very big presence in the 2048, to moderately positive, where it wants a lot more weight in the 2037 and the Bali region. So that's more or less what we do in terms of the optimizer, and this very, very neatly is a way to sew together all of the things that I've just spoken about, how we combine macroeconomics determinants to get to a score, how we get to expected returns for each bond, and how we combine that in a risk-cognizant manner to form a portfolio.
Okay, so very systematic, robust process, comprehensive risk management, which sounds like a very attractive proposition for our clients. But what are the potential challenges you see for the year ahead, given that the portfolio is still quite duration heavy?
Yeah, thanks, Natalie. I mean, I think it's one of our favorite statements to make, to say that in the past 2 years, I mean, all risk assets across the spectrum have been heavily indexed to the process of monetary policy normalization by key central banks. We say this ad nauseum, but it has the good attribute because it happens to be true, right? So one of the things that we do know about the South African bond market is that if we look at the period since WIGB inclusion, that's around 2012, we've had quite a substantial foreigner presence in our bond market. In other words, the amount of non-resident ownership of the South African bond market has been substantial, right? But what has happened of late, and particularly in the past 2 years, is that we've seen the non-resident ownership of the South African bond market whittle down from around 43% in around 2019, 2020, all the way down to about 24% today. So what has happened is, in this environment in which there's been a recoil away from risk, in which there's been substantial amounts of uncertainty, we've basically seen foreigners cash out of our bond market, right? So their footprint is substantially smaller. And because of this, you have this phenomenon that because they are away and they are absent from our weekly bond auctions, the banking sector has to take on the role of the final almost buyer of last resort. So a nominal auctioneer is not allowed to fail. The banks have to mop up any demand that is not being bid for in the weekly auctions, and foreigners are not present. This is a bit of a long-winded way to really say that in the South African bond market now, all bets are really facing in the same direction. What we need is for foreigners to enter and re-emerge in the weekly auctions to take the other side of the trade. And when we think the dust is settled with regards to policy normalization and global flows can once again take on a risk-seeking nature, that we will see precisely that dynamic re-emerging, and this can potentially be a catalyst for yields compressing in the near future, hopefully.
Thanks, Reza. So very interesting view. We remain positive on the back end of the curve. Now let's go over to the front end, Henk. Let's chat about the March MPC meeting. So the SARB hiked rates by more than we expected. What does this mean for the fund positioning, and how is the market pricing in future rate hikes?
Yeah, thanks Natalie, and thanks everyone, and good morning. Thanks for joining us. Hopefully a little bit more simple. When we come to the front end, we've had quite a high degree of complexity, but I think what's important is the systematic way of doing things at Prescient really cuts through that complexity and allows us to position portfolios optimally, even in a period where there's a lot of uncertainty. And using that, it's important to look at what happened last week in the context of what was priced, what happened, and what the market expects subsequently. And very interestingly, if we look at the following chart. Okay, so this is a favorite chart of ours. It really just looks at something very similar to what Bastian looked at, and what's the market expecting South African interest rates to do over the next 2 years. Let's just switch some of these guys off, and very interestingly, if you see, so that's the current JIBAR rate, or what we would call the reset or 3-month rate, currently just under 8%. It's a very high rate, given historic sort of context. This was us a month ago, so the market expecting a little bit of an increase, and then similarly to the Fed, expect them to start reducing rates, and this is where we are currently. So obviously what we saw, an outsized move relative to expectations, so 0.5% relative to 25 basis points. Not that meaningful in the bigger context of things. Now again, expecting a little bit more increase in the front end, but more importantly in our view is this expectation in the back end here of rates going back down to sort of a 7.5 level by the start of 2025. So similarly to what Basti said, the expectation of the SARB to start reducing rates, very important for us when it comes to positioning portfolios really on the front end of the yield curve. If I then take that into a little bit what we will call the belly of the front end, and really look at that rate over the next sort of 3 years, just zoom in a little bit. There we go. And this is the average of that rate over the next 3 years. That's the rate we were looking at, so the 3-month rate. And then what we can do is look at the difference. So what we can see is sort of from the middle of last year, a lot of expectation of interest rate increases that has now come down all the way to almost nothing. We saw a little bit of a blip post the real sort of repricing after the inflation print of January for the Fed. But what now again is evident is that putting your money away for 3 years relative to 3 months, you're not really getting any sort of pickup. In fact, you're getting less, or you're earning less in the 3-year space than what you are in the 3-month rate there. So what does that mean for us from a portfolio perspective? Really, is if you're looking at positioning a portfolio from a duration perspective, you want to favor fixed rate right in the front end. When we get to the belly, sort of the 3, 4, 5-year area, you want something more of a floating nature, some credit, maybe some pickup above JIBAR. And when we do take on duration in the income fund, which we still have, is to focus on the areas that Reza has shown us, really exploit that opportunity really in the back end of the yield curve, where there's still quite a lot of value for us.
Thanks, Henk. So there's been a lot of talk and concern around credit markets, specifically the subordinated debt of banks after the writing off of the Credit Suisse AT1 bonds. So what is Prescient's view on this, and what do we see happening to these instruments in South Africa?
Yeah, great question. Thanks, Natalie, and also something that's come up from a lot of clients recently. We do think there's a bit of a misconception around this. So to what Basti and Reza has very eloquently explained around Silicon Valley Bank being a very idiosyncratic event that had almost nothing to do with what happened to Credit Suisse. So going transatlantic wasn't really the case there. That was a completely different story. And then if we have to dive even further into what happened to the additional Tier 1 bonds of Credit Suisse and what that should mean for our bonds in the local market, that's also completely separate in our view. So the way the Swiss regulator would work, and this is, I'm going to try and simplify something that's not very simplistic, is the tools and the power that the Swiss regulator has is not the same that what the SARB or the National Treasury at South Africa has. The way those bonds operate and the way the ones in South Africa operate are also completely different, fundamentally different because of certain things and certain factors that play into our banks that's not necessarily the case in the Swiss space. I would implore you to go read the piece that Reza wrote around this quite in depth, and we'll explain a lot of what we're trying to say in a short space of time. But suffice to say that the way we would look at the evidence, if something would have had to happen to our additional Tier 1 bonds because of what happened to Credit Suisse and the bonds in that market, we should really look at what happened to spreads in our market. Okay, so looking at this chart, This is the additional tier 1 spreads, or the price we're paying or getting paid for taking on this risk in the local bond market, at least local credit market for different tenors. So let's just switch off the 10 and 7 here because there's not a lot of issuance in that space, and look at the spreads for what we would say a 1 year, a 3 year and a 5 year additional tier 1 bond is in the current South African context. And what is very evident here is a very sort of muted path, and very sort of not very exotic type of movements, and certainly very little evidence of any spike or move or impact from what happened to the Credit Suisse additional tier 1 bonds. If I had to overlay what happened to the offshore market AT1s, or COCOs as they are referred to, there was certainly a spike and a realization of the sort of underlying risk to these bonds. It's very important to understand those risks, but in our context in the South African market, with the health of our banks, the health of the Prescient credit process, and understanding the different sort of triggers and the health of our banks, and what the pricing has shown us for these bonds, certainly in our view there's very little to be concerned about. We shouldn't put ourselves in the same camp as the Swiss, and certainly our banks are healthy, and AT1s in the South African context still very much investable in our view.
Okay, Henk, so given that you're saying that there's not too much to be worried about with the AT1 bonds, and Reza is saying that we are still positive on SA bonds, how has the income provider fund been positioned? And maybe you can also just take us through what the key contributors and detractors to performance were over the past quarter.
Yeah, thanks, Natalie. Certainly a strong quarter for income. And it's evident, again, if you think about the 50 basis point hike, that was more than what the market expected. The fund still returned north of 1% for the month. Just again highlighting where we have been able to take our duration exposure. Doesn't necessarily have to be in an area what the market deems to be more risky or not. So certainly we think the back end is still very valuable. We still have that position. We haven't changed our duration stance from 1.6 years of duration. But what it does do, and what it has shown us, is where we've now sort of getting to the top of the hiking cycle. There's a lot of opportunity for us in that belly of the front end to look for bonds like the additional tier 1 bonds that's giving us a floating exposure with a very good credit spreads. So obviously quite a tumultuous quarter for us, but a very pleasing return outcome. And really some of the key drivers here, as has been alluded to before, is this sort of fixed rate component, or the duration that we've kind of kept in line with our risk budget, which is about 1.6 years of duration. A very nice fund yield of 10.22, so healthy yield if we look on a forward-looking basis. But that really means that if you look at this sort of yielding component here, which is our what we can call credit exposure, that also contributed quite nicely. So between the duration of fixed rate and the floating rate yield being the key drivers, and also very pleasingly our offshore component, where we try and exploit the opportunities in the offshore market, which I'll touch on a little bit later, certainly has come through this quarter, and we do think there's more to be had from that opportunity set.
Thanks, Henk. So given the positioning that you've just described now, what are the risks that you see here? And also, what is your performance outlook for the year ahead?
Perfect. Thanks, Natalie. So certainly with the uncertainty, it's important to have the systematic approach that we do have. Risk for us in the income side is also very, very important. And I often use this term, we are very surgical when it comes to managing the risk in the income fund. So the risk target for the fund is not to lose money over any rolling quarter or 3 months. And the way we do that is to really try and calculate how much risk are we currently taking in the portfolio relative to how much risk can we take in the portfolio, and that's really a risk budget number. So if I think about that rolling 3-month number, it could mean that I have the next 3 months of yield to spend from a budget perspective, or it's a combination of how much I've already earned relative to how much I will earn, and what does that look like from a risk-taking perspective. Okay, so if we take the context of having some budget number, which is these guys over here, and trying to understand how much risk we are taking relative to the amount of risk we can take, what we've done is to say, okay, it's very important when we're taking on exposure in credit or exposure in the back end of the bond curve, maybe some front end link exposure, some offshore property, preference shares, all these wonderful things that we can buy. What does it mean from a risk perspective when we have these in the portfolio? So what we've done is to allocate a risk proxy to each of those. We've allocated those proxies in a fund, on a fund level, so we can look at the current portfolio and what that portfolio or this current portfolio would have done given the data we have and the history of data we have for all those different asset classes. So what we're looking at here in this beautiful mountain over here is basically each observation or point on this is a 3-month rolling return number or 3-month return number, and you can see very nicely sitting to the right of the 0 line, meaning that we're very good at what we do. No, it just means that we've put a good portfolio together. But more importantly is to look at to the left of this. So where's the risk and the tail of this current portfolio? And what we've done, similar to what Reza and the bond team do, look at a sort of VAR number. So taking a 99% confidence, 99.5 and 99.9% confidence. What's the worst case scenario for the current portfolio? Those are the black lines. And then we look at how much we can actually lose or afford to lose from a budget perspective on a 3-month basis. So the most punitive one being the 1-month yield plus 2 months return, about 1.94%. And you can see it's sitting quite nicely between the 99.5 and 99.9 levels for where we're trying to target it. So not coincidentally, it's just the way we've tried to manage the portfolio. We are very surgical. We understand each and every component of risk that we've introduced. We also understand how much we have to spend. And in managing the portfolio in this way, we are able to avoid any drawdowns over that 3-month rolling period, and certainly give that sort of peace of mind to our clients, creating that certainty over a shorter period of time for a fund like the income fund, and really hit our positive return targets that we are trying to achieve.
Great, thanks so much, Henk. So the banking crisis seems to be under control. There's no systemic risk. We are positive on the back end of the curve, and it's looking like a very attractive environment for fixed income assets going forward with our higher yields and low risk. So thank you guys so much for all of your positive and valuable insights today. Thank you everybody for joining us, and we will take some questions now.
Good morning, everyone. Thank you so much for sending through all of your questions. We'll just jump straight in. So our first question, you spoke about parallel shifts in the yield curve as being the key source of variability over time in bond yields. Has this now changed? Reza, would you like to?
Sure, I can take that one. Yeah. So remember our story on the parallel shifts was that largely informed by principal components analysis, and really what that analysis said is that if you look over very, very long periods of time, and then what you would find is that 90% of the kind of variability, the kind of yield curve changes that you'll find is explained by changes in level. Now that is still mathematically correct, and we're not in any way sort of second guessing that. So what we're saying is that out of every 100 type of changes you're going to get, 90% of them is going to be changes in level. But let's just look at that other 10%. So 4% roughly is going to be changes with regards to slope. And that other 6%, let's just say maybe changes in curvature. So what we're really saying is that it's not that we've underestimated the amount of time that changes in slope actually materializes, but if we just look at the quantum of change in that 4 out of 100, doesn't happen very regularly, but when that 4 out of 100 or 3 out of 100 type of changes do happen, what the evidence basically shows that they were actually massively consequential, and they actually can change the whole shape of your whole expected return profile. So we're just a little bit more cognizant of the things that happen with very, very low frequency that remains unchanged, but still can be very highly consequential. So nothing has changed with regards to our previous assertions.
Great, thanks. Okay, what if you're wrong with your assessment that the banking crisis is already contained? What would the implications be for capital markets?
I'll take that one. Okay, so first I want to start by saying we always have to assume that we can be wrong. So you're never right 100% of the time. So most definitely we can be wrong on the banking crisis being contained. We're well aware of that. But I do want to say we obviously also go with the data and the numbers we can analyze. And so far, really nothing hints towards that. So we have all reason to believe that things are contained. We see massively tighter credit spreads already, lower implied equity volatility. We saw that the usage of the bank term lending program has actually receded for 4 straight weeks now. So it's looking better. There's no reason to assume that things get worse from here. But also want to answer the question, what if? Well, the answer is if the facts change, we will change our positioning. And I think that's something one needs to, something which one needs to be ready to do, to acknowledge that one is wrong. And luckily with our systematic process, we are super nimble. So if the data and the facts change, we can change our positioning on the day. That's one of the key advantages. So we're not worried about being wrong. we always go with the evidence which we can track and measure. But if things change, we change our positioning. Very, very simple. No problem with that. We have no fear to say afterwards that we've been wrong. So far, it doesn't look like that though. But what would be the implication be for capital markets? Hard to say, because I think it depends on quite a few factors. According to Arne, what we think would happen is obviously as a first reaction risk of weaker equities, lower bond yields in the States, potentially higher bond yields in South Africa at the back end of the curve, potentially a weaker rand, like a classical risk off. That's probably the initial reaction you would see. But more important would be to once again look at what the Federal Reserve is seeing, what is the reaction function there, and probably what the solution would be is to once again be repriced for more rate cuts, more rate cuts than we priced for already, potentially slow down on QT. I guess those would be the next steps. As I said, no reason to believe that we are there yet. Nothing indicates, nothing hints toward that, but I guess that would be the factors to monitor.
Thanks, Basti. I think this is a good one for you, Henk. The multi-asset income category has grown and is very diverse. What should we as clients look out for when investing in an income fund?
Yeah, thanks, Natalie, and thanks for that question. It's a very good question, certainly. For us, we have our recipe. And if this recipe works for what you're trying to put together for your clients, then that's certainly something we would appreciate, and our fund would then obviously work for you. So how do we see an income fund at Prescient? For us, it really is about that CPI plus 3 target. That's the return target. But more importantly, on that, we know that clients don't like to lose money in an income fund. So for us, we have our risk target as well. And as I showed you in the risk budget chart previously, we try not lose money over any rolling 3-month period. And for us, that's very, very important. And our ability to understand the risk in the income fund is really what we think that sets us apart. And for us as a manager, and for us talking to our clients, it's trying to explain the risk target, but then also the signature of return that you can expect from the income fund. So very important to understand what we're trying to achieve and how we're going to achieve it is the best answer I can give. Certainly, we've been able to do that since inception, hitting our CPI plus 3 target with keeping our risk target intact.
Thank you, Henk. I think this is the last question we'll be able to take for time reasons. So if you optimize, are you not curve fitting? Reza, do you want to?
Cool, yeah, maybe I can address that one. So really, if we think about what curve fitting really is, you think about bonds along the term structure, and what curve fitting is, that is essentially it tries to draw almost like a straight line mathematical model of some sorts through all of those dots kind of thing, right? And then what would happen is that you'd have a particular shape of the curve, and then let's just say we're looking at the 2048 point or the R186, we'd look at the distance from where the R186 is now to its proposed or supposed position on the fitted curve, let's just say, right? So what we're actually not doing is, so we're not actually doing that. We are saying, if I want to look at an expected return for the R186, let's just say, I'm actually looking through time, and I'm looking at actual changes that the R186 has experienced through time, conditional on a state. So whenever the model is in a particular state, what actually happens to the yield of the R186, and I'm just looking at that through time. So it's not curve fitting in any fashion. That doesn't come into the picture at all.
Thank you, Reza, and thank you everybody so much for joining us today. Have a great day further.